Good day. Welcome to everyone who has joined us for our second in a series of webinars on providing the background to financial directors, owners of businesses, and finance departments to understand some of the key issues they need to be concerned about when managing foreign exchange risk within their organizations. My name is Sharon Constançon. I'm Chief Executive of VALUFIN and Constançon Currencies, and I have been many years in this industry and have learned how every organization is so unbelievably unique in the way it has to deal with its foreign exchange challenges. So I thank you for joining me today, and I'm going to run through just a few slides that we did from slide number 1, just to put it into context so that we are in the situation of what is currently important to organizations and what part of the journey we're on in terms of this webinar versus the others, and to put in context that we're only looking at one part of Forex management today. So today we're going to be looking at the very early stages of foreign exchange management. And the first thing we just picked up from the slide last week, or last session actually, is that every business is different. Foreign exchange markets are constantly changing. So therefore, no one day is the same, no one decision is the same. So Forex does have a difficultness to it. It does have a complexity. It's not easy to do foreign exchange risk management. And just for future use for yours, if you're chatting about these things internally, just as a cheat sheet, a couple of key areas that create this sort of pyramid structure, your foundations being that within the environment of your company that you're operating, there are some complexities that exist. The aspects being things like the type of instruments you could use, the types of credit lines you've got, the product, the shipping time, the degree you get unders and overs on shipments. All these things create a noise which often companies don't try and manage, and that in itself has a huge cost area to foreign exchange outcomes. The other foundation that we're having to deal with, and it's a reality, is that the markets are volatile. The Forex markets are actually the most liquid market in the world, and therefore we have got a high degree of constant change. So if you think of it, this market is not just companies that are trading in it. It's all the speculators, the arbitrageurs, and all the currency trades that are going behind commodities and other activities that are happening. So it is extremely liquid. And the one day to the next day, you might get figures coming out of the States. For example, we had recently where there was some statistics coming out to the States on the debt issue and whether they'd reached an agreement. And the challenge that this agreement hadn't really been reached yet, which is negative for the dollar, negative for the US, negative for their trade situation, cash flow situation. But yet the dollar improved. And it improved because you ended up with a safe haven status that the dollar holds versus gold, for example, which doesn't hold that to the extent it used to. And everyone went and bought dollars, even though there was a negative dollar signal. So there's sometimes a huge amount of illogic that happens in the market as well. So we have to be in a position to be independent and able to act as companies when those markets give us these unusual behaviors that happen to be in our favor. So what are we going to do about them? How can we be proactive about them? The other aspect is just accepting that your business is unique to any others. So if you take a look at customers that I look after, I have got one that is in fashion, and their cycle is 18 months in advance that we are thinking all the time. And then we have another organization that's in agriculture, and we're worrying about 6 months of the year when that product comes off the land and goes into international to its customer. And that is just a window of 6 months. And then I might have somebody else who works in a just-in-time in a certain commodity that they import from China, for example. We have others that are exporting, and they're exporting into Europe, but they equally export into other parts of the world, and how those different currencies affect the same company. So these are the kind of things we need to consider. So there isn't one size fits all in foreign exchange. That definitely is a term that doesn't work. And it is important for us to understand what is important for our organization specifically. I've just carried the slide as to why we have converted the various stages of Forex understanding into a mnemonic. And the reason is it just makes it easier to remember why, what, and wherefore. So for us in this particular example, we've used the name of the company and we've broken the whole Forex process into 7 logical steps. So the step that we are going to look at today is the first one, value. What kind of value is important that we put into our structures and our governance to ensure that we're going to be at least starting off on the right foot as our foundation. So to take that one forward, we're going to look at V for value. Component parts of the framework of value are things that we're going to look at in detail in a moment. But what is important is behind every sustainable, successful business, you'll find a clearly defined strategy. Within that strategy, or falling out of that strategy, organizations will create governance structures, policies, procedures, processes, which team members will be taught to engage with, as does technology engage with all those activities. And the building block that we add onto that is the structure of the Forex delivery system. How do we delegate to different people in the chain? And I like to have the analogy of it's like an octopus. Forex will touch so many aspects of the business. It reaches into many areas of the business. So it's important for us to understand which person's doing what part of it in the chain and how are they responsible for the beginning and end of their piece, such that somebody else can do their area of the business. And what we want to have at the end of this is through the building blocks of VALUFIN, you as a finance director will be in a position to understand what those component parts and how they all build on top of each other and how you can actually work to make sure that all those areas are working effectively in your business. It's not just in the finance department that this happens. We also have an area in which we talk about relationships. Relationships are who we talk to, who we engage with, who we might buy our Forex from, who are the different stakeholders in our business that need to know what the currency rates are or what our hedging rates might be. This could be our purchasing department, it could be our sales department, it could be the people that are putting together a cohort of products on a special sale. If they don't know what the costing rate is to the company, they're not in a position to make the maximum opportunity of getting balance between market share and profit share. So it's important for us to know where the Forex is at all elements. And we have to empower our people to manage Forex, but we don't want to empower them to the point that they go and do things outside of policy. This is the fun thing that we tend to find quite often when we join into companies and start to work with them, is that quite often people have quite maverickly started to do their own thing. And there's no system that net has caught that kind of behavior and brought it back to center or within policy, or that they've changed policy to adapt to what is a good process. So it really is important that we get the foundations right. As with any building, if they're not, they fall down, quite simply. And we know that Forex can cause high degree of cost at every turn. And that high degree of cost we need to be able to control and not allow these inefficiencies into the system, because very often you see a P&L figure on the balance sheet or the income statement, but that actually is not really the P&L. It's the opportunity lost and the opportunity costs that you may have in the system as well, that you cannot in any way account for, but you can understand so that you can make sure that they're not there when they're negative, and that you're grabbing all the opportunities you possibly can. So going down into the component parts of value, we talk first about strategy. Strategy is the direction the business is going on. It's the roadmap for the company. I like to liken strategy to the music sheet for an orchestra, and ensuring that all the people in the orchestra have got slightly different music sheets, but actually they're all playing to the same outcome all the way through the process. The next thing that we would like to, just staying with strategy for a moment, focus is needed to find how Forex fits into the bigger picture. So we need to ensure that within the board, within the executive, within that team, that we actually do correctly understand where Forex touches it. It touches sales, it touches purchases, it touches component parts, it touches our competitor strategy. So all those things are the places where foreign exchange is going to have an influence on the way we do things in an organization. And that is led by equally our risk appetite. What is our risk appetite to different things happening in the business, and also to understand what our competitors are doing in the foreign exchange world. And you might take, for example, you've got somebody who's importing back in the 90s from Europe, somebody was importing from France and somebody from Germany. We had the French franc and the German mark, and we had two currencies that ourselves and our competitors were working through. Now they would both operate in euro. So the degree of impact of currency on that strategy would be zero now, but very high then. But we might find, for example, that somebody is looking to import or export from China, and they're either using the renminbi or they are using the US dollar, and I'm trading in euro. So if I'm trading in euro or sterling, for example, I would have a very different currency strategy to our competitor. And it's understanding how that creates opportunity and risk to ourselves in terms of market share, and as a result of that, profit and loss. So we've got pricing issues, we've got risk appetite. Risk appetite is important as to how we're going to define our hedging strategy. And organizations tend to think that 100% covered and 0% covered are on the two ends of the appetite spectrum. They're not, they're both on the same end, high risk. To take one decision around foreign exchange once in a year means it'll be wrong many, many times. At least with the portfolio, which is what we're going to go through in a lot more detail shortly, in terms of the sessions we're going to go through, you will then understand that we need to be somewhere between those two words of 100% and 0%, which are sitting at our high end of risk, and look at a way of how do we mitigate some of that risk out of there. We also look at the markets and our customer markets. The other side of our chain is our supply chain, is also our delivery chain. Our delivery chain, we might have a customer in the US and our competitor from the UK, for example, is exporting into Europe. You might have, for example, an exporter that is actually exporting into China in dollars, and we're exporting into the US in dollars. Our supply chain could be different, our credit terms could be different, our risk of change could be different. So even though the currency element in this particular example is balanced, the other strategies are not. So we also have billing options as to whether you choose to bill in your home currency or whether you choose to raise invoices in your home currency, or whether you take the strategy that looking after the currency management is likely to give you a better answer than leaving it to an average rate conversion for the year, once again giving you no control over the issues at that point. So the other thing, the next stage we want to go from strategy, the next thing that falls out of that is policy. What is our policy? So our policy is about how do we do things here? What are the instructions we're going to put into the system to define how we're going to deal with this risk that we have now brought upon the business by trading internationally? Risk is not bad. Risk is something you need to understand. So it's not that it's a negative thing. It's a thing that needs to be managed. So we then look at what are the hedging strategies this organization has as an opportunity for themselves. And we also then have a look at where are we between 0 and 100 that we can use to look after our Forex management, and how do we basket that together in terms of the time horizons we're working with, the currency pairs we're working with, and how can we consider what is the best way to create balance in a very volatile environment. We also need to understand in our policy whether there are tolerances. If the figure says, for example, I need to be 50% covered, if you're 49 or 51, are you expected to do something about that? Or are there tolerances within certain percentages or intentions within certain percentages that we then say we wouldn't be taking action, we'd be taking more mindful consideration? It's important in a business to understand who makes what decisions. and where does the decision-making chain occur, and what are the risks of time thwarting your business decisions to the point you always end up making them and taking action too late. And Forex moves quickly, it moves now, you're in a meeting, by the time you've got out, the opportunity's gone. So having all the decisions with one person is not productive. It actually creates risk within itself, because everyone says, well, I can't do anything, and don't do anything. And meantime, they should have had some degree of delegation of decision-making to people within the organization, so that they can actually find a way of, within the chain, of saying, we need to take action now because we've seen the market peaking in our favor. It's very important also to consider our environment and the way in which our environment is changing. So I'm not talking about the green space, at the E of ESG. What I'm talking about is our pestle environment that we operate in. The currency pairs, the volatility, the country, the industry, the norms in that industry, the impacts that global trade are having, all those things that are impacting my business. I need to be able to understand how we're going to write into the policy, whether there is a consideration to be taken on that before you start to hopefully respond rather than react to market movements. We have to consider technology. It's an enabling factor. You can buy it, you can rent it, you can lease it, you can create it. You can put it in the cloud, you can have the hardware yourself, you can work with another provider who gives you who operates the software for you, and you give them the data. There are various ways in which we can deal with the technology element. And our technology partnerships range from Excel, a back of a cigarette packet is probably the furthest over that way, scribbling a note on an email to somebody, to then looking at Excel spreadsheet, an ordering system, for example, that's either integrated or not into the accounting system. And you take it right up to an enterprise risk management system where there's an element around the currency side, and you've got big financial style software that you are operating at a more enterprise level. Now, if you look back 15, 20 years ago, these were very high physical, demanding pieces of hardware, software, far outdated today to be using most of that old style software. Most things have become a lot more agile, a lot more easy to use, to provide front-end reporting on top of them. So you might yet still work with a legacy database system that you have. That is okay if you're getting data into it in an appropriate way. And then use the big data reporting tools that we have in today's day and age that pulls that data out of where it is and makes it useful to us, and therefore makes it a decision support system for us. It doesn't make the decision, because none of the kind of things we're talking about right here is empowered enough to have the ability to make the decisions. That's the stage we're moving to, where I think the invention of the AI type of solution, a certain amount of logic is going to be able to be built into these reporting tools that will allow them to turn into decision-making tools, even if you're operating on older systems as the underneath. And the other thing that technology does, our spreadsheets do, is make sure we understand the marriage between what was the underlying invoice and what was the underlying foreign exchange activity. And at what point do we marry those two together? Long ago, at payment, or somewhere in between. So we've got some companies that go for the 100% strategy, the marriage occurs at order. The others say we don't do it at all, in which case it happens at payment. But usually there's somewhere in between that there's an allocation, if you're working on a portfolio, but a marriage between an invoice and a forward transaction to occur at the point at which the funds were paid or received. So if we then move on to structure, it's the way in which the treasury function of your business operates within the market. A sole proprietor who runs a startup business will be doing the foreign exchange themselves. If you're working with a mid-sized company, there might be 2 or 3 finance people to which this function has been delegated. If you're looking at something equivalent to a FTSE 100 organization, you might find you've got a treasury department, which has got a number of people in it. So that treasury function, however big or small you have, is all doing the same thing, but just on different grandiose levels at which they might operate. The other areas that we need to look at is incentives. Incentives in the structure can deliver the right behavior and more of it, or can have unintended outcomes. And people tend to get away from the control environment, get around the control environment, or do things their own way. So there are various ways in which we have to look at making sure that Forex is done most optimally within the organization. And we often see when we do go out to companies that is probably not the case. That quite often it's done in a mathematical way, a logical way, a step-by-step way, but not the best way. And that can be so different in any organization. So in those structures, we'll always have a delegation of duty, delegation of seniority of decision-making. But I think the most critical we look at is ensuring that there's transparency of the information and an understanding of the information. Next component part of value is relationships. Who do we work with that supplies us our currency? Where in the supply chain does the whole supplier, shipping, movement of the goods occur? So it's all the physical side around the business. We then bring in the currency provider, the foreign exchange activity that needs to happen. And then we have a look inside the company to say, well, what relationships do we have with accounting? What is the Treasury functions remit? How is it operating? And then how do we make decisions and how do we report? And then we have the other end of the spectrum. If you are exporting your product rather than importing, it's understanding your customer, the transport through to them, and the different areas in which you could make, lose, or just lose opportunity in that business chain that occurs. Country norms, we all know that we live in countries that have got different degrees of liquidity, different degrees of exchange control, different degrees of being markets open for trade versus not, different degree of maturity of our financial services sector, and the different degrees to which countries have got available liquidity to allow funds to leave the country. Now, most current countries that are less mature and less internationally traded, the more they have a desire to hold on to home currency and not let it out the country, or to hold on to dollars. Those are the two things people like to hold on to. So there are countries, and if you look at the emerging world, you look at, for example, China at the moment, they have got quite a lot of regulation. If you look at the southern part of America, if you're looking at Africa, you do have a control mechanism that is not totally free trade, free currency trade. And if you go to certain countries in Africa, there is no liquidity. You can't buy $10,000 and have it wired over to somewhere in many of the African countries outside of South Africa. But there you have a very prolific black market, what they call a parallel market in some of the countries, and in others they call it their cash market. And there you will find activity happens completely out of the reporting mechanisms of the central banks. And where the liquidity is virtually none, you've got a greater degree of activity in these kind of spaces. So we see, for example, the movement of cash for some of our customers becomes extremely problematic. And the problems emerge when they didn't realize at the time of building a business relationship with the customer or a supplier that there was this Forex challenge in the first place. Had they known that, they would probably have structured the deals very differently to cater for the business risk that has now arisen. And I've got this in 2 customers at the moment, where they are not getting their funds out of 2 different African countries. Where there is just not the liquidity to get it out, but there is a parallel stroke cash market, and is trying to understand the risk appetite to transact in that market or not get your money. And whether you do business in that environment, again, where you're not mature enough to deal and understand the way that market works, or that you have a risk appetite for doing something that is outside of the central system. Regulations, we know we all feel that we are over-regulated globally in every respect, particularly financial services. We all want to get rid of the degree of regulation that keeps coming down the track at us. But nevertheless, we as currency traders and as companies that import and export, you're dealing with your own regulation, and you're dealing with the country's regulation into which you're trading or buying from. And you need to understand what those limits and restrictions are, as those I've just described a moment ago. If you take somewhere like South Africa, they're sitting somewhere in the middle where there are fairly strict regulations, strict requirements, strict evidencing, limits, maximums that you can trade. And in those types of circumstances, if you are the trading partner to a South African organization, whether you're in Africa or whether you're in the first world of Europe, for example, you do need to know what limitations they are dealing with, what exchange control approvals they need to get. Otherwise, you're going to have expectations that are not going to be met. So it is important to know your other trading partners' regulations. You need to know what the process and systems and evidencing that those regulations require and how they get conformed to and who does it. And nobody wants to be on the wrong side of any form of foreign exchange misdemeanor in any country. That now builds our VALUFIN, a V of VALUFIN, and it is basically a strong foundation that allows us to now move into our next stage of Forex consideration. So we have done a piece of this company uniqueness that we have now dealt with, and some of our internal knowledge that we have dealt with in terms of understanding our business. As I said in our last session, you have to know that your company inside out first before you have any hope of addressing foreign exchange successfully. So for your reference, when you pick up the recording, I have gone through the just some key bullet points of what fits into these 5 different components of foreign exchange management, and things like liquidity, volatility, some of the things we've just spoken about, and where they fit into this influence that we have upon our whole Forex management strategy and ultimately our foreign exchange management delivery. So these are the things that you and your organization need to make sure you've discussed, you've workshopped them through, and you understand how they're having a positive and or negative influence on the business. And this might not be something you have all the answers to, so you can brainstorm this with outside consultants and specialists, or you can go and do some reading up on it, or you can listen to a webcast of mine and try and understand how you can learn to do that better. Obviously, as VALUFIN, we do this as a service. We don't provide currency to you as a customer if you're of ours. You as a customer get your foreign exchange from a bank or a broker. When we are working with customers, we work as their management team. We still use the same broker or bank. So it's not about how and where we buy it, unless that does need changing. It's more about how do we decide what we're going to do when we engage with the provider of the currency. So it's knowing myself, knowing my company, knowing what I need to do that's best, and then you engage with the marketplace and say, I'd like to buy or sell whatever is required. So also just for continuity, these are the different component parts of the foreign exchange market and the types of instruments you might be taking and how they will, and from which avenues and providers you might be able to get forwards, forward derivatives, options, CFDs, spot trades, whether you have a short or long supply chain, and making sure that ultimately the spot and the interest rate you are managing, because those are the core foundations of your foreign exchange component, rate, price of the instrument that you are buying or selling. So on that, I'd like to thank you for listening to V of VALUFIN, which is our first component, which creates the initial foundation around understanding your foreign exchange, the risks that exist in the business, your appetite, and how you are going to now step forward and engage that inner knowledge that you have learned to now adapt the A, L, U, F, I, and N. And in the slide from last week, there is the slide that covers the whole ambit of the foreign exchange knowledge situation you need to get yourself to, all the things you need to be aware of. And for your ease, I will add that now as the last slide to this, so that you've got the complete picture, even though we have only looked at one element of it today. So I'd like to thank you for attending. Thank you for being with me today. And I look forward to any questions you might have that you would like answered so that you can help yourself do foreign exchange better than you are doing it at the moment, we're ready in here to brainstorm with you. I'd like to thank you for your time.